Hi everybody, welcome to another update on Stock Screener. There was a request to look at Equinox Gold, so let's do that. Share price hasn't done that well. It's flat for the year. Is it going to go up or not? Let's check that. So here we have Equinox Gold. Where do we start? So they are ramping up their new project, Greenstone, which is going to bring production from 560,000 to 700,000 and eventually 830,000 to be conservative. And there could be more growth, of course, but I'm not counting that in yet. So that's the production. Gold price 2,200 is my target. They had some capex to build Greenstone, and I think the future capex will be around 100 million. Of course, this can go up or down, but this is the estimate, and they do have some debt that will give interest payments, so that needs to be counted as well. I took 36% tax rate, and this is the result. EV to free cash flow around 13 to 11. It's fair value. I'm not saying that it's overvalued, it's fair value. High mine life, 20 years, 15 to 20 years, so that's good. It is profitable, but I'm not saying that this is undervalued, so I wouldn't buy it. It will go up and down with the gold price. That's all it will do. Now, on to the costs. This is where the problem is arising. The costs are at 1,715 all-in sustaining costs. That's very high costs. This is the 2024 cost guidance. And what I want you to look at is the old mines. So don't look at Greenstone, that's a new project, which has a very good cost structure. But look at the old mines. What is the all-in sustaining cost average of these old mines? So I did 70,000 times the costs plus 32,000 times the cost, etc. And I divided it by the total production of these old mines, and I got 1715 all-in sustaining costs for these old mines. That's a very high cost mine. These are high cost mines. Some are even 2000, 1800, 1900. You are not going to get a lot of margin with that. And if inflation keeps rising, that could be a problem with these very high cost mines. So that's the 1715 which I used here. And that's the production, 585. So that's the old mines. And then we have the new mine. They only own 60% of that. All-in sustaining cost, I think, around 900. And gold production, 350. Take 60% of that, that's 200. So my valuation is using 5 times EBITDA with the old mines plus 60% of the new mine, and that gives me this valuation. So I see currently at the current gold price, yeah, there is a bit of upside from an EBITDA perspective, maybe 10%, but it's not undervalued to me. Now this is market cap. What we also need to take into account, and that's what everyone misses, is that they also have debt. What is the debt? So the market cap is around fully diluted 1.8 billion. What is the debt? Much more. It has huge amount of liabilities, 2 billion, cash 800, so that's around 1.2 billion in debt and other items that form a lot of liabilities. So enterprise value around 3 billion. Okay, 3 billion. Actually, I should not look at market cap. I should look at enterprise value. That's more important to give me the correct valuation. So at 2,200 gold currently, I see downside to here because it's overvalued. Um, Even at full production in 2028, at this gold price, the 5 times free cash flow is around here. So there's downside risk based on the enterprise value. So the problem with Equinox Gold is the high debt. They will need to pay off some of the debt, and that money is not going to shareholders. That money will go to paying off debt. And that's also visible here. 3 billion in enterprise value. All of these cash flows will need to be distributed between paying dividends and paying off debt holders. And as you can see, it's not going to the NPV. So this is the NPV. NPV is not reaching the enterprise value, so we are overvalued for Equinox Gold, right? So I would not buy it. I think it's a bit overvalued from an NPV to EV perspective. EV to NPV is 1.75, taking into account all of these things. And 1500 is probably the long-term average costs. And how do I calculate this? I took the old mines production times AIC plus production of the new mine times AISC 60% divided by production. So this gives me 1,500 average costs, which I use here. Of course, they can keep improving these things in the future. I don't know, but currently this is the situation. And I don't see a lot of upside in Equinox Gold. Now, what happens when gold goes up? That's also something to look at. I have comparables here. Alamos Gold, Equinox Gold, Artemis Gold, Oceana Gold, Kainan 2 Gold are on these charts here. As you can see here, at which gold price does this EV to NPV start to go asymptotic? This one looks very bad, Oceana Gold at 2000 gold. Equinox Gold is also bad, around 2000, 2100 gold. So not good. There are better alternatives like Kainan 2 is much better. Artemis Gold is also a better buy. Almas Gold is somewhere in the middle. And the upside, currently at 2200 gold. Equinox is this one. I don't see any upside. I only see downside, but around 2500 gold, Equinox should do much better. Then we cross the zero line, and then we could see upsides like 20%, 50% if we cross 2500. But of course, there are better alternatives like Artemis Gold, which already has upside, and Kainan 2 Gold has also upside, more upside than Equinox Gold. And even Oceana Gold is better. based on our assessment of costs and production. So yeah, that's my assessment. And the last chart is this one. 700,000 production, 830,000 costs from 1,700 to 1,500. Interest payments, capex are all included, tax rate. So at 2,200 gold, there is indeed downsides. I would not be buying this company. So what do I think the share price is going to do? Absolutely nothing. That's what it's going to do. It will stay here and do absolutely nothing, even if gold goes up to 2,400. Yeah, it will stay flat until they can cut the costs. Costs are much too high at 1,700, 1,500. And this picture paints it all. Just look at the cash flows that come in, and you will know if it's a buy or not. If you compare this to another company, a junior, like Serabi Gold, look at the difference. Look at the cash flows. It goes above the enterprise value. It doesn't stay below the enterprise value, it goes above it. That's when you see upside. And then when you look back at Equinox Gold, look at this, abysmal. It stays under the enterprise value, while Serabi Gold goes like this. So easy buy is Serabi Gold and not Equinox Gold. But yeah, this video is about Equinox Gold. I don't see any upsides, and that's it. See you next video. Bye.